For 6 consecutive years, Fortune magazine named one company America's most innovative company. Every single one of those years, from 1996 to 2001, that company was building one of the largest accounting frauds in the history of American business. The company was Enron. And the paradox at the center of its story is not simply that a fraud went undetected for a while. It is that for 6 straight years, the people whose job was to identify the most innovative company in the country looked directly at Enron and gave it the award anyway. This episode is about how that happened. Not just what Enron did, but how a company built in large part on an accounting illusion managed to look, from the outside, like the smartest room in American business, right up until the room collapsed. It is also about what that collapse cost the people who trusted the illusion, many of whom never once stood on a trading floor or wrote a single accounting entry. Enron did not begin as a trading company. It began as a pipeline. On July 16, 1985, Houston Natural Gas and Internorth voted to merge natural gas pipelines. Kenneth, who had led Houston Natural Gas, took charge of the combined business, and over the next decade he pushed it in a very different direction. Enron stopped thinking of itself as a company that moved gas through pipes. It started thinking of itself as a company that traded contracts on natural gas and electricity first, then on weather, on broadband capacity, on water utilities, and on commodities as varied as steel, coffee, and sugar. It had convinced much of Wall Street that it had found a genuinely new power plants, but by trading the risk that moved around them. By the year 2000, that transformation looked extraordinary from the outside. Enron claimed revenues of nearly $101 billion for the year, a figure that placed it among the very largest companies in the country by that measure alone. Fortune had already been naming Enron America's most innovative company since 1996. It would keep doing so through 2001, a run of 6 consecutive years. From the outside, this looked like a company that had found something nobody else had found, reinventing an entire industry and getting rewarded for it every single year. To understand what was actually happening underneath that reputation, you need to understand one accounting decision made early in Enron's transformation. Jeffrey Skilling, who ran the trading business and would later become chief executive, pushed the company to adopt what is called mark-to-market accounting. Skilling argued that this method represented what he called the true economic value of a contract. Here is what that meant in practice. Once Enron signed a long-term contract, the company could immediately book the estimated present value of all the cash it expected to receive over the life of that deal as current income, not the cash it had actually received. The cash it expected to receive sometimes years into the future, based on Enron's own projections. Think about what that allows. A company signs a 20-year energy contract, estimates optimistically how profitable that contract will be over 2 decades, and reports the entire estimated profit. If the contract turns out to be far less profitable than assumed, that correction does not have to show up until much later if it shows up at all. Mark-to-market accounting let Enron turn optimistic guesses about the future into reported profits in the present. The more optimistic the guess, the better that quarter looked on paper. Most companies recognize revenue only as cash actually arrives, a slower and more conservative approach than the one Enron applied to its trading business. Once a faster, more forward-looking quarter's projections a little more optimistic than the last was effectively built into the system itself. That alone created a problem because optimistic projections eventually run into real cash flow, and real cash flow does not lie. So Enron built a second mechanism to manage the gap between what it was reporting and what was actually happening. Its chief financial officer, Andrew Fastow, who took that role in 1998, built a network of off-balance sheet partnerships, legally structured as separate entities, that existed largely to take Enron's underperforming assets and debts off Enron's own books. The 2 largest of these partnerships were called LJM1 and LJM2, created in 1999 and named for Fastow's wife and 2 sons. Their purpose was to serve as the outside investor that these special purpose entities legally required, so the assets and debts inside them would not have to appear on Enron's own balance sheet. One set of these entities, known internally as the Raptors, ended up holding more than $1.2 billion in assets, including millions of shares of Enron's own stock and $150 million in Enron notes payable. Enron was, in effect, using its own stock and its own promises to prop up entities whose entire purpose was to make Enron's own books look cleaner than they actually were. On paper, the structure satisfied the accounting rule requiring a genuinely independent outside investor. In substance, Enron had become its own customer, its own guarantor, and its own hidden creditor, all inside the same set of transactions. And here is the detail that tells you almost everything about the incentives running through this structure. By his own later account, Fastow personally profited from LJM to the tune of $45 million, while claiming he spent no more than 3 hours a week managing it. The company's chief financial officer, the person whose job was to protect the integrity of Enron's books, was collecting millions of dollars from the very entities designed to make those books look better than reality. Inside the company, the culture matched the accounting. Skilling introduced a performance review system that employees came to call rank and yank. Every review the bottom, regardless of their actual performance, and given 2 weeks to find another position inside the company or be let go. Imagine working inside a system like that. It rewards people who can make their own numbers look good this quarter, not people who raise quiet, structural questions about where the company's numbers actually come from. A system that punishes the bottom 10% no matter how the company as a whole is doing is not really measuring who is failing. It is measuring who is willing to keep quiet. Skilling had a phrase for how he wanted the company to see itself. He is remembered for saying that they were the good guys, that they were on the side of angels. On February 12, 2001, that same executive was named chief executive of Enron, taking over from Lay, who stayed on as chairman. He would not hold the position long. But for a moment, the architect of mark-to-market accounting and the rank and yank culture was running the whole company, at the exact point Fortune was preparing to give Enron its Innovation Award for a 6th consecutive year. The first serious journalist doing something remarkably simple. She asked how the money actually worked. On March 5, 2001, Bethany McLean published an article in Fortune titled, "Is Enron Overpriced?" Enron's stock was trading at 55 times its earnings, an extraordinarily high valuation, and McLean's question was not accusatory. It was almost naive. If this company is worth that much, can anyone explain, in plain terms, exactly how it makes its money? Inside Enron and across Wall Street, remarkably few people could give her a straight answer. 6 months later, on August 14, 2001, Skilling abruptly resigned as chief executive, after only about 6 months in the job. Lay resumed the top role. No public explanation offered at the time fully accounted for the sudden departure of the man who had just taken over the company he had spent more than a decade reshaping. A week after Skilling's resignation, someone inside the company tried to warn the top of it directly. On August 15, 2001, that the company risked imploding in what the writer called a wave of accounting scandals. A week later, on August 22nd, a 6-page letter arrived, this one signed, from Sherron Watkins, Enron's vice president of corporate development, laying out specific accounting concerns in detail and warning that using the company's own law firm to review the matter would present a direct conflict of interest. Enron did open an inquiry into her warning. It did not use independent investigators, and her concerns were largely dismissed. The warning did not stop what was coming. It only tells us, looking back, that inside the building, at least one person had already worked out what an outside journalist was only beginning to ask about in public. Watkins later testified before congressional committees about what she had seen inside the company. In 2002, Time magazine named her one of 3 persons of the year, alongside whistleblowers from the WorldCom accounting scandal and the Federal Bureau of Investigation. The company had dismissed the warning. History did not. And the real ones had grown too large to manage quietly. Enron's stock had closed at $90 a share on August 23, 2000, its all-time high. 17 months later, on January 11, 2002, it closed at 12 cents. In October 2001, once the scale of the accounting problems became public, the Securities and Exchange Commission opened an investigation. By November, that had become a formal inquiry. On October 16, 2001, 1997 through 2000. The correction cut previously reported profits by $613 million, about 23% of everything the company had told investors it earned across those years. The same restatement added $628 million in liabilities the company had kept off its books, and reduced shareholder equity by $1.2 billion. A further correction on November 9th cut reported revenue for the same years by another $591 million. The innovation fortune had been rewarding for 6 straight years turned out to be, in significant part, an accounting construction. The consequences were not abstract. Nearly 62% of the retirement savings held by Enron's 15,000 employees were concentrated in Enron stock, purchased at $83 a share in early 2001, and now worth almost nothing. One documented account from that period describes married couples who had both worked at the company losing as much as $800,000 to $900,000 combined. People who had built their retirements around largest accounting frauds in American history lost those retirements at the very moment the fraud became public. The company's outside auditor did not survive the fallout either. In early January 2002, it emerged that employees at Arthur Andersen, the firm responsible for auditing Enron's books, had shredded documents and deleted emails connected to that audit. On June 15, 2002, Andersen was convicted of obstruction of justice. With that conviction, the firm agreed that August to surrender its license to audit public companies, effectively putting the firm out of business. A firm that had operated since 1913, 89 years, did not survive the 2 months it took to be tied to Enron's shredder. Enron filed for bankruptcy on December 2, 2001. At the time, it was the largest Chapter 11 filing in American history, a record later surpassed by WorldCom in 2002 and by Lehman Brothers in 2008, and it is still described as the largest bankruptcy caused specifically by fraud in United States history. The company that collapsed had employed approximately 20,600 people worldwide. What followed took years to resolve in court. Andrew Fastow pleaded guilty in January 2004 to 2 counts of conspiracy to commit wire and securities fraud. As part of that plea agreement, he had agreed to serve 10 years. When he was actually sentenced in September 2006, the judge gave him 6 years in prison, followed by 2 years of probation. Kenneth Lay and Jeffrey Skilling were both convicted on May 25, 2006, on charges that included Skilling alone was found guilty on 19 separate counts, including conspiracy, insider trading, 5 counts of making false statements to auditors, and 12 counts of securities fraud. He was sentenced that October to 24 years and 4 months, later reduced to 14 years under a 2013 agreement with the Justice Department, and was released in February 2019 after 12 years in custody. Lay never served a day of his sentence. He died of a heart attack in Snowmass, Colorado, a few months before he was scheduled to be sentenced. Because he died while his case was still open on appeal, his conviction was formally vacated that October, under a legal doctrine that treats a defendant's death before a final appeal as erasing the judgment entirely. In the eyes of the law, Kenneth Lay was never convicted of anything. In the historical record this episode draws on, the trial, the verdict, and the evidence presented at it all still stand. The journalist who asked the first hard public question about Enron did not stop with one magazine article. Bethany McLean, together with fellow reporter Peter Elkind, published a book in 2003 called The Smartest Guys in the Room, later adapted into a documentary film directed by Alex Gibney in 2005. The title was not a compliment. It described exactly the reputation Enron had built for itself internally, the sense that its own executives were simply smarter than everyone else in their industry, smart enough that the ordinary scrutiny applied to other companies did not need to apply to them. The scandal also changed the law. Enron, alongside a similar accounting collapse at WorldCom and a handful of other corporate frauds, helped prompt Congress to pass the Sarbanes-Oxley Act, which President George W. Bush signed into law on July 30, 2002, calling it, in his own words, the most far-reaching reforms of American business practices since the time of Franklin D. Roosevelt. The rules that govern how public companies report their finances today exist, in large part, because 6 consecutive innovation awards were not enough to catch what mark-to-market accounting and a handful of hidden partnerships had actually been doing. That is, in the end, what this story actually establishes. Once the legend is set aside and only the record remains. Enron's fraud did not require the world's most brilliant criminal mind. It required an accounting method that let hope be booked as income, a set of partnerships that let debt disappear from view, a review system that punished anyone who slowed down to ask why the numbers looked so good, and an outside world, journalists, analysts, and award committees included, that for 6 consecutive years treated confidence as though it were evidence. Historical account drawn from public court records, regulatory filings, and reputable reporting. It is not investment or accounting advice, and it describes only documented events and legal outcomes, not any claim about what a specific individual privately believed at the time. So here is the question for the comments. Was Enron's collapse the failure of a small number of people who chose to commit fraud, or the failure of a system, the accounting rules, the incentive structure, the awards, and the analysts that rewarded the appearance of genius? I want to read where you land on this one. And in the next episode, we leave the world of accounting tricks for a much simpler kind of gamble. 2 brothers from Texas tried to corner the entire global market for a precious metal, and for a few weeks in early 1980 it looked like they might actually pull it off legally in plain sight. Then came a single Thursday in March that erased almost all of it. That story is next.